nothing but mammals, so let's do it like they do on the Discovery Channel.
You and me, baby, ain't nothing but mammals, so let's do it like they do on the Discovery Channel. You and me, baby, ain't... Oh, crap! Oh my God, ladies and gentlemen, I am so embarrassed. Anyway, welcome back to Strongman Personal Finance. My name is Christopher Bell. I'm a certified public accountant. I'm a long-term boglehead investor. I'm author of the book, Stop Being a Broke Loser. It's on Amazon for an insane $3. And I'm an amazing t-shirt and coffee mug designer. Links in the description of this video. So go buy stuff so I can get rich. So I don't have to work anymore. Anyway, today we're going to talk about La DISCA, also known as Discovery Stock. Now, I've been seeing a lot of YouTubers talking about Discovery. Why? Because the stock went up right here? Short squeeze? No. But a lot of people have been talking about it. And I think it's for a good reason, because it might actually be a really good value play. As a matter of fact, I put a total of $500 into this stock because I like it. I think it's a decent play, okay? But you know, if you want to go with Tesla, if Discovery's stupid, Tesla. If you want Tesla, if you want to buy Tesla, you go right ahead. But I think Discovery's not a bad deal. But don't lower your life savings into it. So this is DISCA stock. So basically, it's been flat for the last 5 years. Then it seems like there was a massive short squeeze, and then it freaking plummeted down to where it's at now. And I currently have a massive 4% gain, and I made 20 bucks. So I'm richer than you, boy. So I like to look at the financials on this channel. I know it pisses all you people off because you just think, just buy whatever stock sounds futuristic. It's the future, bro. And that's all you do. But I don't do it that way, okay? So let's go read a little bit more about this company. And I downloaded the most recent quarterly financial statements. What's that? So let's go read management's discussion and analysis. Management's. Here we go. So I did a little bit of highlighting, massive due diligence. But basically, I like this company because it's very diversified across a bunch of different products, mostly TV shows, and is diversified internationally, not just in the United States, internationally. You want a company that has sales both in, the United States and around the world, because if the U.S. goes to crap, well, at least they have the other side of their business, yada, yada, yada. And you also want a diversification of products, a bunch of different TV shows, licenses, etc., because it's a more diversified portfolio. It's common sense. Now, you can always go to the 10Q and read the management's discussion and analysis of financial condition and reports. This is basically the management talking to you and telling you kind of what's going on with the company. So, for example, we provide original and purchase content and live events to approximately 3.7 billion cumulative subscribers and viewers worldwide through networks that we wholly or partially own. It's about half the world's population. As of June 30, 2021, we have 17 million total paid Disney subscribers. Or not, Discovery subscribers. Disney. We distribute customized content in the U.S. and over 220 other countries and territories in nearly 50 languages. That's pretty diversified. Our global portfolio includes prominent nonfiction television brands such as the Discovery Channel. Have you heard of that? Our most widely distributed global brand, HGTV, Food Networks, TLC, Animal Planet, Investigation Discovery, Travel Channel, Science, Motor Trend, blah, 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 blah. Other networks, Spanish networks, Discovery en Español, Discovery Familia. Wow. They even have international stuff, okay? They have a Polish media company, Discovery Kids, Child's Entertainment Latin America. Is this diversified enough for you? On top of that, they just launched a new service in January 2021. It's called Discovery Plus in the U.S. across several streaming platforms, and entered into a partnership with Verizon, which is offering access to Discovery Plus for up to 12 months to certain of its customers. Wow. So basically, a bunch of different stuff, globally diversified. I like it. Now, we need to go and look at the disaggregated revenues. And one more thing before we do that. They also did a recent merger with Warner's Media, which was a spinoff. AT&T basically bought them and then spun them off recently. Warner Media provides entertainment, sports, and news assets. So, like I said, more diversification. This company isn't going anywhere anytime soon. Now, let's go look at the disaggregated revenues, and let's see where their sources of income come from. Because even if they have international networks, you still want to see how much money they're actually generating from international. Because if they generate $1 of sales from international and everything else comes from the US, then they're not really globally diversified. So you always want to go look at the disaggregated revenue, which takes the revenue on the top of the income statement and breaks it out. And so you can actually see like different sources of revenue. So if you look at the bottom here, it says 6 months into June 30th, and they have 2 years. They have 2021 and they have 2020. Looking at 2021, we have, what is this in millions? They have $3.7 billion of revenue from U.S. networks, split between advertising, distribution, and other. International is $2.08 billion. So roughly 30-40% of their revenues come from internationals. That's pretty good, okay? You compare that to the previous year. U.S. was 3.5 million, and international was 1.7 billion. So it looks like international is actually growing at a faster rate than U.S. networks. I mean, you want to do a little bit more research about what's going on, but to me, that's pretty encouraging that it's globally diversified. They seem to be taking a lot of steps to really diversify, their entire portfolio. Now, let's go look at La Morningstar. So here's Morningstar. It's a 5-star rating for the stock. Doesn't mean anything. You shouldn't trust ratings. But you can get a quick snapshot of what's going on with this company. The main thing I noticed was that there's a 17% short interest. I wonder what the short thesis is. I don't really know, but we'll have to see. You have to do your own research. Morningstar has a fair value of 42. I mean, I would never trust Morningstar. I would do your own research. But if you go on Morningstar, which you can get free from your local library, hopefully, you can go to key ratios and then hit full key ratios data. That pulls up all this information. You can export it to an Excel file, and you can drop it into this lovely thing that I made. Now, what does this have? It has all their financial data, so I'm able to quickly check, okay, how's their revenue growing over time? How's their operating income changing? Share buybacks, how's that going? What is their net margin? What is their free cash flow as a percentage of sales? Yada, yada, yada. It helps you make better assumptions by looking at data over time. Because you don't want to look at 1 year's growth. Like, let's say they have massive growth, like they did. They had 53% revenue growth in 2018. I believe that was an acquisition. And then they had more revenue growth, 20% in the last quarter. You need to really look at trends over time and make reasonable assumptions about revenue growth. So, let's see some of the numbers that I did. So here's my little tool, which is totally not, 100% not a ripoff of Everything Money. I swear, okay? Actually, I think they stole from me. I should sue them, okay? Because this was my format. And of course, I have some pictures here, which obviously this is better than Everything Money's. I should charge for this, okay? You get to see all these little clowns and their stupid little, oh, hey, and their little clown hair. It's pretty hilarious. I like it. So currently, Discovery stock is trading for $24.42, and it had a recent run up. It went up like 4% yesterday. I made my massive 20x gains on Discovery. Now, revenue assumptions. I like to be conservative. I think this company is going to keep growing their revenues. Broadly diversified, bunch of acquisitions. I like it. I said conservatively, it's going to grow low of 3, high of 5. You can do your own assumptions because if you go back and you look at revenue, you can see they've had periods of massive growth and then periods of stagnation. So you could even average it out. But I would roughly grow it in line with, the growth of the economy. It's a more mature company. It has potential to grow really fast, but the bigger the company, the more likely I am to have lower levels of revenue growth. Because you can see some years it's had 5%, 53%, 5%, 1%, 2%, 13%, 23%. I mean, it fluctuates pretty significantly. But if you're conservative and then the revenue grows faster, you just made more money on the stock. Share change. Share change. This is share buybacks or share issuance. So it looks like they issued some shares in 2019. So if you did an average, you would almost think, hey, it looks like they're issuing shares. But if you see over the last year and then the last 12 months, they've been buying shares back. So I've assumed, because they've already made most of these acquisitions, it's possible they could issue more shares, but I don't think so. I think it's much more likely they're going to start buying shares back. So worst case, they don't buy any shares back. And you can even change that number if you want. It's up to you. Best case, they buy 2% back, which is pretty reasonable in my opinion because they have lots of free cash flow. Profit margin. Let's go look at the profit margins. So as you can see, you can average this out. I just like to take a like a spitball estimate. If you look the last couple of years, it's been 13%, 11%, 12, and then over the previous couple of years, or like maybe say 5, 6, 7 years ago, it was in the mid-teens or low 20s. So if they can tighten their shot group up, or at least stay where they're at right now, 11, 12, 13%, it's still a buy. What would hurt this stock is if their profits significantly decreased. So I said 11, 12, 13%, low, middle, high. I think that's reasonable. Free cash flow is a percentage of revenue. This company, from what I remember, is a cash flow machine. Yeah, look at this. Free cash flow is a percentage of sales. So look over time, 24, 22, 21, 19, 18, 19, 21, 23, 27, 21, 20. Pretty good freaking cash flow as a percentage of sales. So I did 19, 21, and 23% as a free cash flow as a percentage of revenue. Now, PE, mature company. I mean, it's growing, but it's pretty mature. I like to be conservative. 8, 10, 12, 8, 10, 12. And of course, I want a 15% return. 15%, bro. You can even do 20 if you want. But look at these freaking numbers. Okay, ignore this crap down here. This is for companies that have earnings in foreign currency. Look at these freaking numbers, man. This is a buy at the low assumptions. If you're looking at this, our free cash flow, that's freaking massive buy. And if you have your high assumptions, it's a buy for multiple of earnings. But just look at that free cash flow, bro. That's freaking crazy. And if they're able to increase their profit margins back to where they were before, their net margin, which is their accrual basis of accounting, this thing actually freaking updates. This company's a buy all freaking day, okay? Now, what could go wrong is that your assumptions could be completely wrong, and that's perfectly fine. And sometimes the market's just stupid, like it is right now with Tesla going up Tesla. Up. Stupid. You have to be patient when you buy stocks like this. So what I recommend is do your own due diligence, really consider your assumptions, really do a lot of research, plug them in, be conservative. And if you think it's within a buy point, just put a little bit of your portfolio in it, okay? It's up to you. But overall, you should be maxing your tax advantage accounts and buying total world stock market index funds. So if you speculate on a stock like this and it doesn't pan out, you're going to be fine. So overall, I put $500 into the stock. I think it's a pretty decent play. You know, I think it's broadly, I love it. It's broadly diversified, got a huge audience. They're making moves to grow their business. The revenue margins are good. The free cash flow margins are good. Profit margins are good. Share buybacks, I think that's going to happen. It's not bad. I like it. And of course, there could be a short squeeze, and then I just sell it all and make a killing. So that's my thoughts. I like it. I would definitely consider this stock as a small part of your portfolio, but it's up to you, okay? Anyway, like, subscribe, tell your friends about me. Y'all have a wonderful day. Choo!